Hey everybody, Courtney Smith here with your weekly video newsletter, TradeSmith. You've been waiting for it. It's here now. All right, let's get right into it. What's really here now is this disclaimer. And, well, I know you know what to do. Read it. All right, I'm going to start out with something a little different. I'm going to focus here on the dollar. The dollar took a big dive here, particularly on Friday. It was down a little bit during the week, but then on Friday, we've got news out, a few pieces of news. Weak U.S. economy was one big piece of news that hurt the dollar. Another piece of news that hurt the dollar is that the Japanese came out with stimulus, which was expected, and I told you about it last week. It wasn't as much as they were expecting. So as a result, the dollar dropped against all currencies, but really dropped against the yen. That was the one that really had a big move. Now, what happens is that markets are interconnected. So many markets affect so many other markets. There's an intermarket dynamic going on all the time. So I think that the dollar was one of the big dynamics this week that had a big impact on a lot of markets. Like what? Well, commodities, energy, gold. And usually when the dollar is weak, those commodities are strong. And we saw that happen this week. Now, here's the thing. If we look at this from a fundamental perspective, I'm still actually quite bullish on the dollar because I believe that that since the U.S. has much higher interest rates than other countries and a stronger economy than most other countries, that both of those things will cause money to flow into the United States, thus strengthening the dollar. But from a technical perspective, this is not a particularly attractive looking chart. Now, it looks to me from a pure technical point of view that we'll probably trade down to that lower uptrend line around 94, and then we'll start to see those bullish fundamentals kick in again. But that might take a week or two. So for the next week or two, I think we need to be on the bear side of the dollar. But what that really means is we need to be bullish gold, we need to be bullish oil and energy, and so on and so forth. So this is one of the critical things that's happening in the market. There was a couple of them. Also, the bond market was big, and I debated whether or not to make the bond market my featured chart. Let's look at the S&P 500. Is that the world's most boring market? Look at this. So that's like the world's most boring market right there. Look at that. We closed almost unchanged for over a week. Now, one thing that's interesting is down in the lower right-hand corner, we see that volume is starting to increase. At the same time, we saw a little teeny bit of strength on Thursday and on Friday. So I think we're about to make a new leg higher. We had the pause that refreshes. We've consolidated the gains. Now we should be ready to go for more gains. Still don't think this is much of a bull market, though. All right, it's just kind of sluggish. Look at that. Since April, the market really has been a piece of garbage. Dow Jones, slightly worse than the S&P. So how does all that work? Well, I'll tell you, here's the key. The actions in the NASDAQ now, the actions in technology stocks. So look at the volume increasing here, supporting, confirming the bull market we're seeing in the composite, in the NASDAQ composite. I'm looking at technology now. That's the place to be. We were in consumer staples. We were in utilities for a long time. And that was the place to be. Now the place to be is in these wonderful technology stocks. So get yourself focused over there into a much different sector than where we've been. So that's where we want to be. Seasonality, pretty neutral. Our indicator here is the IWM, kind of neutral. Seasonality, we got to start thinking that maybe those top lines are the ones that are more important. As we've broken out to a new high here in August, which of these seasonal patterns would that be? Well, it would be the green line, the very top one. That's the line that when incumbents win, okay? So if the Democrats were to win the presidential election, that's the seasonality we would see. The blue line also has higher highs here in August, and that's all presidential election years. So that one would be sort of more the normal case. The incumbent party winning, there's not as many examples of that. The purple line, no sitting president running, that's in the middle. That one looks okay. But I'm going to have to say that the seasonality we should focus on is the blue line, all presidential election years, with the possibility that the market is telling us that Hillary is going to win, which would be the green line. But I think we can definitely reject the yellow and the black lines down at the bottom. That's bullish news. Yield curve still putting a cap on prices. This is one of the reasons why the market's not exploding to the upside. Asset allocation started to turn against stocks late in the week, and now we're seeing bonds gain, stocks decline. So where our focus is, and even in the stock side, as I pointed out, we don't really want to be in the big boring stocks. We want to be in those technology stocks. Stock market risk indicator is showing that as well. The market wants to go into risky stocks, not lack of risk stocks. And of course, that's really NASDAQ or technology. They're riskier stocks. So that's why we're seeing this rally. Global shares starting to pick up, but still don't like them as much as the U.S. stock market, where we're making higher highs. Bonds turned around. We talked about this last week. I told you that we're at a critical time, super critical, and I also told you that I thought that we were going to continue to move higher. We had just made that key reversal, and then we followed through on the upside, and now we've really followed through on the upside, and so we've got to be back on this bull side, just as I told you last week. Now, look for new highs. Look for new lows on interest rates. Look for new highs on the bonds. This is big. This is big. Bond key factors, 2 out of 3 are saying lower interest rates, and only 1 out of 3, that's the gold market, is looking for higher interest rates. Let's take a look at gold. Speaking of, wow, it took off. It took off before the dollar got spanked, so that's pretty good to me. I look at this and I say, this is a pretty bullish chart. Now, another thing here. We're now going into the seasonally super strong period of time for gold. We've got the Indian wedding season coming up in October, and that causes gold to rally 85% of the time in August and September. That's a strong seasonality. So we've got to be looking for reasons to get long. Last week, I said we were at a critical point. We bounced up. I must admit I was a bit more bearish last week. But now, with the dollar coming under pressure, with the Indian wedding season coming up, the big, powerful seasonality, be long gold. Be long gold. Our key indicators, last week, all 3 were bearish. Last week, all 3 were bearish, which is why I was like, I don't really like the gold market. But look at what happened. 2 out of the 3 exploded to the upside. And the other one, the third one, the middle one, it's kind of hooked up even. So we need a few more days to really say if it's hooked up for sure. But we're very close to having 3 out of 3 bullish. Got to be long gold again. I'm sorry I was a little bit bearish last week, but that's because all 3 of these indicators were bearish, and I have to follow the indicators. I have to be reality-based. The reality now is this is a pretty bullish looking situation again. Oil, look, this is pretty interesting to me too. You know, I've been bearish now for some time, and that's been the right side of the market to be on. What's happened here is that we saw the dollar sell off hard. That's why I wanted to focus it. Oil should rally. Well, we got a little teeny reversal bar on Friday, but it's not a very important looking reversal bar. So I have to say, I'm still staying on the bear side in spite of the weakness of the dollar. You see, when this market goes down in the face of bullish news, that's really bearish. So I'm actually in a way more bearish on oil now because it's not rallying the way it should. All right, all you freebies, you know we love you. You know we love you. But we love our fully paid up members even more. So go up to that website up there, sign up. You know you need to do it. You know you want to do it. All right, fully paid up members, stick with me and we'll get to you right away. We got some great trades.